Hi guys, thanks for tuning in to another episode of Nuggets News, or our monthly housing and economy update with our friend Martin, coming live to us from the UK again. How are you, Martin?
Yeah, pretty good. Just I had all my studio stuff dumped on me a few days ago, so I'm frantically trying to put the studio back together. It's still in pieces, but at least we've got a green screen and hopefully a reasonable mic now.
Yeah, absolutely. No, you're looking great and sounding great, and I'm very jealous that you get to go to the Ashes soon.
Yeah, Ashes, Wimbledon. We're doing all the summer treats here while I'm in the UK, so looking forward to it. And the weather's been quite good for the last month as well, remarkably.
Great
Won't
to
last.
hear. Great to hear. Another chaotic month of global markets, and we're starting to see some divergences between different countries and central bank policies. I'm sure we'll dive into some of the stuff happening in Australia with the labour market. It's been very interesting. So, any general thoughts before we dive into the slides?
Yeah, so we're in chaos, obviously, because there is on one hand the market saying, "Hey, everything's fine." We've got AI and the tech sector booming, and the stock markets have been performing quite strongly. We've got central banks on one hand jaw-jawing they're going to go higher, but the markets don't believe them. So you've got this real dichotomy of sense at the moment of our rates going to go higher. But the third point is rates have already gone up a long way and households are being crushed. Not all households, but enough households for it to be a real problem. So that's really the true story, I think, that this is actually already now biting. But the delay between rates rising and the impact on real households and businesses is 12 to 18 months, which means that there's a lot more pain to come.
Yeah, and that point you made about AI and tech leading US markets, I want people at home to keep that point in the back of their mind for when we talk about some of the relevant Australia labour productivity and all that kind of thing. It's really important as we get into all of that. So let's
Yeah,
dive
good
into
point.
those slides, Martin. And the ECB's raise rates slower than the US or UK, but you haven't got Australia here as well, who have been a little bit slower than the rest.
Yeah, I thought I'd just start with the ECB because they lifted again last week. Of course, the Fed didn't. Australia did, of course, last time around, and the expectations they'll do it again. But the point is that wherever you look, rates are going higher. And of course, in Australia, we'll come on to the Australian situation a bit later. But in Australia, very different change. The markets were very strongly of the view that the RBA would not move again. Now that they're of the view they probably will. And you've seen the impact on bond rates and things like that really changing. So the cost of money is continuing to go higher. And I don't think that central banks are done yet. Inflation is still raging.
Yeah, and New Zealand across the ditch even more aggressive again at 5.5% now for their benchmark rate.
And in recession, they've officially now hit recession as expected. And of course, the New Zealand central bank there said, we are going to create a recession. Well, they've done it.
Yeah, I think a lot of central banks are now towing that line as well. But price pressures, headline CPI at least has come down a little bit in the US.
Yeah, it's interesting that core CPI is down a little bit. We're not seeing some of the same relief in other places. So in the UK, inflation is still very high. We expect the UK Bank of England again to lift rates again this week on Thursday, I think it is. So the question though is this inflation really as sticky as a lot of people are saying, or will it really come down? But there are some base effects. So effectively, we had a lot of energy costs dropping out and a few others, but things like rental costs are still significant. Food prices have come back a little bit, but are still pretty significant as well. So I have the view that the US story of inflation is not yet done. And my expectation is that we will see more inflation for longer, which means the New Zealand situation will probably mirror what's going to happen in the US recession.
Yeah, and I think when we look at this chart, around when inflation peaked, that was kind of when the fear of inflation peaked as well and markets bottomed. So I think now it's kind of about, well, are we going to have a second hiking cycle, which has begun, and how big is that going to be? And whether or not it's just a clear path down back towards zero. I don't think that's the case anymore. I think it's a bit more
Yeah.
turbulent than what markets forecast. So it's
Well, it's
changing.
interesting. The dot plot from the Fed was up higher for longer. And higher for longer is, I think, the thematic around rates, right? We are going to see rates higher for longer. We probably will never see them come back to those ultra low rates. I think that those ultra low rates were a policy mistake. It created a huge surge in money supply, it created massive amounts of credit. So we're in a new risk environment. And in fact, what's interesting is if you look at the credit risk gauge, which is the next slide, you can
Yeah.
see there that after the Fed rate forecast, the risks are higher. So markets are saying we think there are more risks in the system, right? Now, the point there is higher rates, more risk, and yet stock markets is booming, thanks mainly to AI. This You can't square that circle, and that's the problem. Something is going to give. Either the markets are going to break, or the inflation is going to come down much quicker than a lot of people are expecting. But so far, the ability for any central bank to forecast inflation accurately has been close to zero. So I think longer for higher is the rates. Inflation is going to be a problem. That means the markets are out of kilter. And I suspect that the AI boom is a bit of a mirror of the tech boom, the dot-com bubble around 2000. So maybe the forward expectations of all those AI businesses is way up ahead of where the truth is.
Yeah. Okay, so we've heard a lot about this in Australia, but this is all over the world, I guess, that individuals and households are now starting to talk about inflation at the at cafe and out for dinner and at work, and so those expectations are higher.
Yeah, this is actually from Deutsche Bank, right? So Germany. The point I want to make is this is not just a Australian problem or a US problem, right? The Eurozone is also in the middle of it. Germany is still struggling with inflation. It's really starting to hit individuals. And like I said, there's a delay of 12 to 18 months between rate rises and the impact. So a lot of individuals, businesses are now really starting to feel the pain. And whilst the expectation is that maybe, things are coming down, the pain is going to hang around for a lot longer.
Yeah, and China's that interesting one. They've actually cut interest rates going against the
So
Fed.
China has had a bit of a boom when they opened post COVID, but it's not really been sustainable. The inflationary pressures are a little bit easing there, but they're now calling for more stimulus. They dropped a couple of their target rates recently to try and encourage a bit more momentum. And the view from the US is that China will stimulate quite hard. Now, if that happens, that could be quite helpful for Australia. But my view is it's unlikely that we're going to see a similar mode of stimulus to what China did in 2007, 2008. That was very much an infrastructure build. I think now with 20% unemployment for young people in China, they're going to be focusing much more on local alternatives and getting consumers perhaps to consume more rather than actually thinking about just building more stuff that nobody wants. So maybe we're not going to see a replay.
Yeah, they've already built the ghost cities. Now it's time to get people in them and young people jobs and that type of thing, as you say.
Yeah, and if you look at the next slide there, the producer price index was down, and basically deflation is now the real risk in China. And if you think that China saved the world economy post the global financial crisis, which is pretty much what happened, if deflation is running in China, we're going to see deflation forces spread more broadly. And that's why I've had a long-term thesis that whilst inflation's a problem now, deflation is the real long-term haunt. And this could be now the sort of first precursor of what we're going to see.
Yes. Japan's also revised GDP higher.
Well, Japan is an interesting stand-up because they never drop rates. They're already low and they've not lifted them, right? So the GDP in Japan is pretty good. The stock market is also in Japan doing pretty well, and so you can see there as inflation comes down in Japan, the stock markets in Japan are also very, very strong. So there's a different path. Now the question is, will ultimately they have to start lifting rates? But they're not signaling that the new governor of the Japanese central bank is signaling we're going to continue this path. So they've got a different divergent path. But ultimately, the question is, can they continue to do that, or will they have to actually join the party later?
Yeah, it's a good, I guess, experimental case, isn't it? They're still at minus 0.1%, while the rest of the world's gone aggressively to 4, 5, 6. Yeah.
Yeah, there's such a gap now. And if you look at the next slide, look at the RBA rate hike, right? So this is actually showing you the days since the first hike in the cycle, right? And so the RBA has really accelerated dramatically relative to previous hiking cycles. And now, of course, recession is now a major concern in Australia. A number of economists are saying a recession in 12 months, in the next 12 months is almost baked in. CBA says 50-50. It's interesting that I've been talking for quite some time about the risks of inflation and recession in Australia, and the consumer is now withdrawing. David Jones released some information quite recently. It was private information that got leaked, but showing how much discretionary spending has dropped, and we're seeing that more broadly as well. So consumers are really, in the case of those with mortgages and those with higher rents, dialing back their spending. Others, of course, are still spending quite well.
And we've spoken in the past about this posturing and jawboning when they come out and say things like this, just like when they said they weren't going to raise rates and people act on that information. They kind of want to install a bit of fear and say, hey, there's a recession coming, and try and get people to start to spend less as another tool to get in front of that inflation.
Yeah. There's a real jawboning going on, and of course, it's a matter of will they do what they say they're going to do. But it's interesting, the markets. If you look at the interbank cash rate, the markets are now saying rates will be higher for longer. So in October 24 now, it was 4.1. Previously, it was about 3.4. So you can see this change trajectory with much higher rates now baked in by the markets. Now, these are only indicative, but this is a reaction to what the RBA said and the last rate hike. So you've got to expect more interest rates for longer, higher mortgages for longer. It's going to put a lot of pressure on a lot of people.
Yeah, and I read a good piece by Chris Joy saying they had that Freedom of Information Act from the RBA minutes or notes, where they themselves were saying, hey, 4.8 might actually be where we need to get to, even though publicly they were saying a few months ago something different. It's obviously...
Yeah. Well, a number of bankers are now, some of the economists are talking could be above 5. So, yeah, this is a very different environment. And to translate that into reality, the housing debt servicing cost, this is from CBA, shows just how much the share of disposable income is now sort of turning around again. So people are having to put more of their income to, and not surprising, because if you had an interest rate on a mortgage of 2%, it's being reset to 5 or 6 or maybe even more depending on your risk profile. So this is now sucking the blood out of a lot of households, and as we'll see in a second, mortgage stress is continuing to bubble higher. This is an economic catastrophe for those households, but also more broadly for the economy. So recession is baked in, I would say.
Yeah,
and if you want another angle, on that, the housing debt servicing costs are also continuing to rise according to the CBA projections. So debt is very costly when rates go up.
Yeah, and so that's that RBA projection there, 10% of household disposable income, and interest as the percentage component of that is obviously going to rise aggressively as interest rates are going up. So you're not paying down as much of that principal. It's just trying to service that interest, which is where we see people start to default and whatnot.
Yeah, and the banks are extending the term of the loan, so they're allowing people to put an extra few years on to reduce the payments. They're allowing people to draw out additional equity to be able to make the mortgage repayments over the next year or two, if you've got equity. And they're also changing some of the other underwriting parameters to try and actually support people, quote unquote. But of course, they're supporting themselves, right? Because what they want to do is to ensure that the loan book does not go bad, but the delinquency rates are up, and that's early days yet, but they're up higher, and my expectation is we'll see more of it, but not immediately, because the banks are being more generous. They don't want to foreclose, so it's not going to be like in the US in 2006, 7, 8, where foreclosures went up over the next 2 or 3 years. I think the banks will muddle through. The reason they want to muddle through is they don't want to disclose how much pressure their mortgage books are in. And if they can define, loans as an okay state because they've extended and pretended, interest only, whatever, those are the tricks now which are in play.
Yeah. Another chart on household savings ratios, and I've heard different things about how much of a buffer we still have after we were able to save a lot, and that hasn't been spent yet. So that's another force that could see inflation continue to be sticky and remain higher.
Well, the point is it's not uniform, right? So there are still households with plenty of buffers, but there are others that aren't. Unfortunately, the people with mortgage pressure and rental pressure are precisely the ones who have no savings buffers. It's always the case, but even more so now. And the ratios now, drop below the long-term average, according to the latest Westpac data using the ABS data. So households, um, some still have buffers, but many don't. Those who don't, they're reaching for more credit. They're refinancing. They're doing whatever they can. They're cutting down on discretionary spending. All of those things. The question is, will it be enough?
Yeah, and we've seen those essential costs of living surpass the discretionary consumption.
Yeah. So what's happened now is that people are actually dialing back on that discretionary stuff. I'm not going to buy that new car. I'm not going on a holiday. I'm not going to I'm not going out as much. They're spending a lot more on the things they must buy, but that's because of food inflation costs are very high. So they're not necessarily buying new stuff or more stuff. They're buying the same stuff, but having to pay a lot more for it. So this is a very important crossover point. This is from the ABS to show that the essential consumption is continuing to rise, but the discretionary consumption is dropping dramatically. This is going to, if it continues, going to be really put a pressure on a lot of the economy. Remember, about 60% of the economy is consumer spending. So effectively, if consumer dials back, another downward force on the overall economy.
Yes, Australia's a very service-based economy at the moment. Younger Australians in the negative now.
Yeah, and this is the other point. I remember I said it's not equally spread. So you've got quite a few households still with deposits, particularly older households, but the younger groups are in negative. So they basically have little savings, no savings. They're underwater, and so this is the point. These are the people who have the big mortgages. These are the people with the big rents. These are the people who've not seen their income grow particularly strongly. In fact, in negative terms relative to inflation. Lots of pressure. Older households, a bit more protected because they've got less mortgages or no mortgage, and they've got other savings. And of course, they'll have stock market holdings, which are doing quite well. Refer our earlier conversation about AI. But this is the unequal story we've now got.
You back, Martin?
Yeah, I'm still here.
Oh, cool. Just cut out for a little second. You're all right. Keep going.
Okay, all right. Okay, yeah, and so there's also a chart here from the ABC. They featured my mortgage stress report this month, and they said young families and renters face unprecedented cash flow pressures as financial stress hits new highs. Very good article, and it included a lot of my data.
Fantastic to see. And yeah, that mortgage stress is continuing to go pretty parabolic.
So this is the Roy Morgan alternative. So it's not just me saying mortgage stress is up. They're different definition of stress, but nevertheless, they are still saying mortgage stress is rising, and you can see it's going up very quickly. So a lot of pressure on a lot of households.
Yeah, just as you said with that previous slide, because rents are so high now as well, these people that will have to sell their homes and can no longer afford their mortgages, just as bad a chance as being able to afford your rent. So I think we're going to see a lot of that multiple family households moving back in with parents, all
Yep.
that type of thing.
We're already seeing the occupation numbers go up. In other words, more people living together. And the other thing that they're doing is the multiple job holding statistic came out the other day, and it's really high. So we've got more people now working extra jobs, particularly females, particularly part-time females, and particularly in some of the caring services. So it's not necessarily, generating a massive amount of income, but people are actually being forced to work more, work longer, take multiple jobs to try and get by. This is another early sign of the pressure on the economy.
Yeah, and I guess this is the part I wanted to touch on about some of the data we got this month about the labour productivity and labour unit costs at 8%, and we've seen that minimum wage increase at 8.6%. I think it was 5 point something percent for the award, which is a quarter of all workers in Australia. So now that we have that inflation running about 7% in Australia, supermarket, all that type of thing, well, now there's a new wave of people that have that little bit extra money to continue to keep up with that, which is great, but it also means that it's going to continue to filter its way up to the companies that take the profits from this extra spending and whatnot. So it continues, I guess, to create that inflation spiral, and that's the biggest driver now. A lot of economists are saying it's wages. Yeah.
And interestingly, did you see the report that said CEO salaries and senior executive salaries are up by 12 to 15%? So it's
Yeah,
completely unequitable, right? So we've got a proportion of people doing really well and enjoying the boom, and not what's problem? Don't see a problem at all. And you've got ordinary Australians being forced to work longer hours, being forced to take extra jobs, forced to cut back, dealing with significant stress, etc., etc. And my perspective is that the political class don't get just what's going on in the real household budgets of so many households. And so there's a real dichotomy between those two. And, the disequilibrium between the lower and the upper in terms of assets and wealth and income is precisely mirroring what's been going on in the US for many years. Unfortunately, we're going down the same route. And I don't think the policies that are being sort of played with at the moment, 700,000 new migrants coming in, a bit of housing stuff going on, but really nobody's wanting to tackle the true issue here. We've got several million households really caught now, and I think recession, inflation, all those things are going to really play through. It's going to be very hard for Australia to avoid a recession.
yeah. The other interesting thing was the productivity is the worst since World War Two, and
Yep.
so I think it was Australia spends half as much as the US on computers and AI, the newer things per capita, and so what we're seeing now is the tidage in the labour market. So you're having to get people with lower skills that are, all things remaining equal, less efficient at their job. So productivity is low, and yeah, this is all feeding into this inflation spiral.
Yeah, and the RBA has been preaching the productivity story for quite some time. They've ramped it up. They're obviously throwing that back towards the government and saying, so what are you doing in terms of productivity improvements? But productivity is hard to improve, right? And as you say, we're not as expert in Australia at using technology, particularly some of the leading edge. The AI boom is really very much a US technology boom. So there's, if you look at the indices over there, there's a 6 to 12 companies, Nvidia and a few others, that have massively accelerated in terms of value. I think they're probably over-egged, but it hasn't necessarily spread. Here in Australia, we've seen a reduction in investment. We're seeing a reduction in the investment in technology, and we are a long way off the pace, I think. And unfortunately, that means that productivity improvements are going to be hard to win.
Yeah, when more and more is going to CEOs and shareholders and that rather than reinvesting, it makes it hard to improve productivity.
Absolutely. And the last chart, I just thought I'd put a stake in the ground. You know that the debt ceiling, as we expected, didn't blow up. They came to a solution. But now the US cash balances are dwindled, and they've got to actually pump up those treasury balances. So we're going to see a lot of securities being issued in the US. Interestingly, if you look at the foreign ownership of US securities, it's been very strong in recent times. But because of the inflation differentials and the exchange rate differentials, investing in US securities have become less attractive. So the interesting question for me will be, will there be a liquidity squeeze in the US? In other words, as they issue these additional treasuries and other securities, will it suck even more out of the market at a time when the Federal Reserve is doing a quantitative tightening? We know that the money supply is dropping quite fast. Is this actually now going to be another factor that actually triggers effectively a liquidity problem, maybe a banking problem, and therefore maybe a recession in the US? So this is one to watch because it's literally now playing out in real time.
Yeah, I guess the final thing I wanted to talk about as well was commercial real estate's getting a lot of chatter again. There's been some articles about how the Australian banks and a lot of the super funds that are heavy into this stuff are going to have to re-mark to market. Some of them are only pricing once a year, and we just see there's such a high percentage of super funds and bank exposure, all this commercial real estate. And they're saying, no, you might have to mark to market quarterly or something. So I think that's another very interesting component of things that might have to get bailed out or repriced. So it's really going to affect the Australian economy.
Now, I think it's a really good point. And of course, a lot of the real estate is unlisted. So, in other words, it's not actually publicly valued in any way whatsoever. And so the question is, are they actually overstating or using historical values that are actually now way out of date? And if they did mark to market, what hole does that create for super funds and for other investment activity across the country? And at the moment, there isn't a lot of good news in terms of commercial real estate. There's a lot of spare capacity, and commercial real estate rents are not rising the same as retail rents. Interestingly, I've seen quite a few arguments saying, well, what we should do is to convert some of these premises to residential, but of course, not all of them are suitable for that. So this is a big problem. It's a sleeping problem. It's not one that actually the regulator, I think, is fully across. And I agree with you. This is one to watch as well in the Australian context.
Yeah, I think it has the potential to turn into like a GFC style domino, because for people at home to understand, if you have all this commercial real estate and these people with their super funds that have built wealth, retirees now say, I want to get 5 or 6% risk free at my bank. I'm going to sell a heap of units of my super fund or convert to cash or higher rated bonds or whatever it is. And then you've got the problem that there's no liquidity there. So they want to go sell these real estate, but there's got to be a buyer. And in times like this, those markets are very thinly traded. There's not a lot of liquidity. And so that's when the RBA might have to step in and start buying commercial real estate, mortgage-backed securities and all that type of thing. So more money printing coming.
Could well be. And, even some mortgages maybe ultimately will be rescued one way or another, right? But we'll see. It's all a playful. So you can see here the dynamism is all over the place. A lot of confusing signals. It's a very complex market to read, but the ultimate question will be how high rates will go, how high will they stay high, and what will the consequences be? And that's the story of for the next few months, certainly.
Absolutely. Well, Martin, we'll be back next month and we'll go keep an eye on the Ashes for tonight. But thanks for joining me from the other side of the world again.
Great to talk with you, and we'll look forward to the next one. See ya.
Thanks, guys. See ya.